Right, let's have a look at the 4 hardest MCQs from the March-June 22 FR exam according to the examiner. First question then. Here we get a company, 1st January X5, they've acquired a piece of equipment for 25 million. It's got a useful economic life of 5 years, so we're going to depreciate it over 5 years. And they must discontinue it, they must decommission it at the end of the 5 years. And at the end of the 5 years, this decommissioning is going to cost 10 million. So that's in 5 years' time, this extra 10 million above the 25. Anything in 5 years' time needs discounting down. And it tells you that the cost of capital is 10% and the present value in 5 years' time of a discount rate of 10% is 0.621. So you now know you have to discount it down by times in 10 by 0.621. It says, look, they've done everything correctly. What is the total charge to P&L for all this? So what goes to the P&L? Right, let's have a look at this. First of all, then we buy the asset for 25 million. Easy, we need to depreciate that over 5 years. But we've also got this thing that happens at the end of the 5 years, this decommissioning. That's also debit asset, but credit provision because we haven't paid for it yet. We don't put it in at its full cost of 10 million because it's not until another 5 years' time. So we have to discount it down. He gave us the discount rate, 0.621. So the amount we put in now is 6210. So our asset now has a total of 6210 plus 25,000. We're going to depreciate that away over 5 years. That gives us depreciation of 6242. And that obviously goes to the income statement. But we're not finished there because we must also have some unwinding. You think to yourself, why do I have unwinding? Because whenever you discount anything down, you must unwind it. So we discounted down this decommissioning provision at 6210. To unwind it, you just times it again by the percentage you discounted it down in the first place at. So 6210, now unwinding, you do that every year, times by 10% equals 621. And the double entry for that, by the way, is debit interest on your P&L, credit provision. So your provision's going to slowly build back up. So your total amount going to the income statement would be your 6242 plus your 621 is 6863. Tricky, but not impossible. Let's have a look at the second question then. He says we've got given a brand name with an estimated useful life of 10 years a few years ago for 10 million. So 10 million brand over 10 years. We're going to amortize it away at 1 million a year, aren't we? Then at the start of our year, it says a brand specialist believed the brand to have a fair value of 14 million. Do we take that into account, what somebody believes, or do we go for an active market? We go for an active market, so we can disregard the 14 million. So it's 10 million over 10 years, okay? So 1 million brand amortization. Then it says they also did a training course. Stop there. What happens to all training? Cost us 450,000. And it says the employees are going to be around here for 3 years. Don't care how long they're going to be around for because they might leave tomorrow. I don't control them. What do you do with all training costs? You put them to the P&L immediately. So the question says, how should you recognise these figures? Well, brand amortisation then, 10 million over 10 years, 1 million would be the figure then that would go into the P&L for that. And the training costs, do you spread it over 3 years or do you put it all in the year it was paid for, the year it was incurred? In the year it was incurred because we don't control it, so 450,000. Keep going then, the third hardest question, or the third question in the 4 hard questions, all about the conceptual framework. And it says, got to decide which of these is true. So is it principles based rather than rules based, but not an IFRS standard? That's exactly what it is. It's something that's based on principles, not on rules, but it's got no IFRS standard. It doesn't overtake IFRS standards. It's there as guidelines. So A is true. B, the principles contained in the conceptual framework overrides any IFRS. No, it doesn't. It's there as a guide. It doesn't override. It requires accountants to evaluate and address threats to compliance with ethical principles. No, that's the ethical code. If it's revised, it won't automatically update or won't automatically lead to changes to the IFRS standards. No, it won't. It probably will do, but it doesn't automatically. The IFRS standards themselves, they win over. So they will go and have a look and say, right, is this standard still applicable? Is it still guided nicely? So it's not automatic. Finally then, the fourth and final question, let's have a look at this. Pearl has a subsidiary that it owns 80%, controls 80%, owns 80%, controls it all. And Silver is selling goods to Pearl. So we've got the subsidiary selling to the holding company, the parent company, for 120,000 at a markup of 20%. Okay, and they'd sold these goods by the year end. Basically, this question is just looking at what's happening to revenue, cost of sales, and NCI. Okay, so whenever you have any unrealised profit, you've got two things to worry about. The unrealised profit bit, you can't make a profit by selling to yourself, and just the whole thing, you can't buy and sell to yourself. So we need to deal with two of those. So let's look at the unrealised profit first. Got sales, cost of sales, and profit. We're looking for the profit figure. He told us it was a markup. When it's a markup, cost of sales is 100%. He told us the markup was 20%, and therefore sales must be the balancing 120% then. So you know that. If it was a margin, sales would have been 100% and cost of sales would have been 80%. So now you can put in the actual figures. What actual figures are we told? We're told that sales was 120,000. So you can now see that cost of sales was 100,000 and profit was 20,000. But the way you work it out is literally like that. So you know that the profit was 20,000 between selling from S to P. But not all of it's unrealised. Half of it's been sold. The unrealised bit is the bit that's unsold. So half of it was unsold is 10,000. What do you do with that? You reduce the seller's profit and the buyer's stock on the SFP. And how do you reduce the seller's profit? By increasing cost of sales. So you increase S's cost of sales by £10,000 and buyer's stock's not interested. We're not doing an SFP on this question, so we can ignore that. And then finally, you can't buy and sell to yourself. So you need to reduce sales, reduce cost of sales by the whole amount. We're not talking about unrealised. We're just saying you can't buy from yourself, you can't sell to yourself. So can you please decrease sales by 120 and decrease cost of sales by 120? So can you see that cost of sales has been increased by 10, then decreased by 120. So overall, a decrease of 110. So let's go and have a look at our question. It says revenue must be reduced by a total of 120. True. Cost of sales must be reduced by a total of 110. True. Now what about this non-controlling interest then? Remember it was S selling to P. So does S have an NCI? Yes it does, because we only own 80. So S has another 20%, has 20% NCI. So we knew the unrealised profit was 10,000, so we've got to get rid of that. But 20% of it belongs to the NCI, so we take 20% off the NCI. And so therefore, non-controlling interest must be reduced by 2,000. Yes, it must. And that's it. They were the four hardest questions in March, June 22, Section A, that is, according to the FR examiner.